What if I told you that the next financial crisis won't look like the last one? There will be no sudden crash on your screen, no loud headlines, no market-wide panic. Instead, the collapse will look like a shopping spree. Because while the world is distracted with political drama, wars, and inflation, something silent is happening behind the scenes. The largest banks and financial institutions on Earth are quietly buying up hard, physical, real assets at a speed we haven't seen in over 100 years. Land, farms, energy infrastructure, water rights, minerals, rental housing, even entire neighborhoods. And almost nobody is asking the one question that matters. Why? What do these institutions know that the public does not? What are they preparing for before 2026? And why is this pattern nearly identical to the behavior that preceded the major monetary resets of 1914, 1933, 1971, and 2008? Today, we're going to uncover a story that has been unfolding quietly, piece by piece. A story of consolidation, crises, and preparation. A story where every signal points in one direction. A financial system losing stability, and the powerful securing what can't be printed. Because when the money system begins to shake, the smartest players stop holding money. They start holding everything else. This is the quiet buyout. Before we explain why banks are grabbing real assets, we need to understand the system they're escaping from. For over 50 years, the global financial system has been running on one core principle. Credit grows forever. It didn't matter if wages stagnated. It didn't matter if debt exploded. It didn't matter if currencies weakened. As long as banks kept lending and governments kept borrowing, the illusion of stability stayed alive. But around 2018 and 2020, something strange happened. The engine stopped responding. Interest rates fell to zero, then negative, then back up. Then inflation surged, then broke records. The old formula, print more, borrow more, stimulate more, began producing weaker and weaker results with increasingly painful side effects. By 2023, global debt hit record highs. By 2024, inflation was still haunting every major economy. By 2025, central banks found themselves trapped between recession and currency decline. The system, for the first time since the 1970s, showed signs of structural exhaustion. And every time that happens, banks make the same move. They switch from holding cash to holding control. That's where our story really begins. To understand the current buyout wave, we must trace the early signals. Signal number 1, the sudden flood into farmland between 2010 and 2023. Institutional ownership of U.S. farmland increased tenfold. Hedge funds and banks bought millions of acres. Price per acre surged to historic levels despite low farming profits. Why would banks who normally invest in stocks and bonds want farmland? Because farmland is inflation-resistant, cash flow generating, tax-advantaged, finite. And most importantly, no central bank can print more of it. Signal number 2, the housing grab in 2021 to 2025. Blackstone, BlackRock, JP Morgan, and major REITs bought entire neighborhoods. Hedge funds became the largest buyers of single-family homes in multiple states. A record number of investors paid above asking price even in slowing markets. This wasn't speculation, it was positioning. Signal number 3, the shift toward hard infrastructure. 3 categories exploded: energy assets, pipelines, LNG terminals, grids, water rights, reservoirs, aquifers, river systems, mineral rights, copper, lithium, rare earths. These assets do one thing: they remain valuable no matter what happens to the currency. Signal number 4, the quiet sell-off of financial paper since 2022. Banks have been reducing exposure to long-term bonds, treasury portfolios, mortgage-backed securities, corporate debt. Because the debt market is no longer stable, rates swing wildly. Governments roll over debt with difficulty. And the risk-free asset, government bonds, no longer feels risk-free. This shift is the biggest silent alarm of all. By 2024, the buyout wasn't subtle anymore. It became systematic. Large financial institutions began treating physical assets not as optional investments but as mandatory hedges. 1. Rising global fragility. Governments were borrowing at record speed. Currencies were weakening. Inflation became persistent. Banks saw the writing on the wall. Paper wealth was losing reliability, so they rotated out of paper and into physical. 2. A coming liquidity crisis. A worldwide liquidity crunch was quietly forming. Banks struggled with deposit outflows. Money market funds grew massively. Repo markets tightened. Credit availability shrank. When liquidity evaporates, asset prices fall, and those with cash buy everything. Banks were preparing early. 3. The dollar's global strain. The world began shifting reserves. China reduced U.S. bond exposure. BRICS expanded settlement networks. Middle Eastern nations moved toward diversified energy pricing. The dollar didn't collapse, but it weakened structurally. For banks, that meant one thing: hold assets that hold value regardless of currency. 4. The age of monetary repression returns. Governments began quietly implementing higher inflation targets, negative real interest rates, capital controls, excess profit taxes, new banking regulations. These policies hurt savers, but protect borrowers, especially governments. Banks understood this early. They adapted. Something major changes around 2025 to 2026. It's not a prophecy, it's a mathematical inevitability. Reason number 1. Global debt passes an irreversible threshold. By 2025, global debt reaches levels that cannot be serviced without massive inflation, currency, devaluation, debt restructuring, or all three. When sovereign debt becomes unstable, every financial product tied to it also becomes unstable. Banks know this. They are escaping the paper system before the stress breaks. Reason number 2, demographics flip the economy. The West is aging fast. Fewer workers, more government spending, less economic productivity. This creates persistent fiscal pressure, fueling long-term inflation. Reason number 3, energy systems hit transition pain. Oil and gas underinvestment collided with the slow rollout of renewables. Energy scarcity became a structural risk. Every previous inflation cycle in history was caused by energy shocks. Banks are buying energy assets for the same reason nations fight wars over them. Energy is power. Reason number 4, the end of the cheap money era. For the first time in decades, interest rates are staying high. These destroy zombie companies, over-leveraged firms housing affordability bond portfolios, and it creates forced sellers. Banks want to be the buyers. Reason number 5, monetary reset patterns align. Every major monetary shift came with the same signals. 1914, gold window suspended, gives physical assets surged. 1933, dollar devalued, Tosei weakened, and commodities protected. 1971, Bretton Woods ends, inflation decade begins. 2008, money printing era starts, gives asset inflation, goes parabolic. Now, in the mid-2020s, all 4 patterns are repeating. Banks recognize this cycle. They know how the story ends. This is the part nobody wants to talk about. When institutions control land, housing, water, food, production, and energy infrastructure, they control the system. Here's how the fallout unfolds. 1. Housing becomes permanently institutional. The more banks owned, the harder homeownership becomes. Rent rises. Mortgages become restrictive. Ownership shrinks. This is already happening. By 2025, in many cities, 1 out of every 5 homes is owned by an institution. 2. Food supply centralizes. Farmland consolidation means corporate control of food production, price-setting power, reduced competition, increased dependency. Consumers lose bargaining power. 3. The middle class is squeezed. Inflation destroys purchasing power. Wages fail to keep up. Assets move into institutional hands. The middle class shrinks further. 4. Governments become more dependent on banks. When banks own essential assets, governments cannot regulate aggressively. They cannot challenge ownership. They rely on private capital to keep systems functioning. Power centralizes in boardrooms, not parliaments. 5. Currencies weaken as hard assets strengthen in every previous cycle. Currency, commodities, land, energy, real assets. The same dynamic is unfolding now, and institutions want to be on the winning side. Some wonder, why don't governments prevent institutional land grabs? Because they can't. Fix number 1. Regulation fails. Any serious regulation risks. Capital flight, political backlash, reduced investment, economic slowdown. Governments need banks too much to challenge them. Fix number 2. Taxation backfires. Higher taxes on institutions often lead to higher rent, higher food prices, higher energy costs. Consumers end up paying the bill. Fix number 3. Printing more money makes it worse. Money printing inflates asset prices, commodity costs, corporate profits. Banks benefit even more. Fix number 4. Public housing projects don't scale. Governments can't build fast enough. Costs explode. Projects stall. Institutions continue buying. Fix number 5. Monetary tightening creates forced sellers. Higher rates gives more bankruptcies, gives more distressed assets. Guess who buys them? Banks. In every scenario, the system feeds the buyout, not the public. History doesn't repeat perfectly, but financial behavior does. Compare patterns. 1930s banks bought distressed farmland during the Great Depression. 1970s. High inflation pushed institutions toward commodities and land. 2008. Banks bought foreclosed homes by the millions. 2020. Segundos. Múltiple crisis. COVID. Debt, inflation, geopolitics, aging populations, energy transitions. And the same institutions are repeating the same playbook, but on a scale we've never seen before. The buyout isn't accidental. It's protective, and it's predictive. Banks are not buying real assets because they want to farm, mine, or rent houses. They're buying them because the financial system is approaching a stress point. A currency shift, a debt restructuring, a liquidity crunch, a monetary reset. Whatever shape it takes, the theme is the same. Paper claims lose value. Physical assets do not. The quiet buyout is not a bet. It's a shield. A survival strategy. And if the biggest financial institutions in the world are moving away from the financial system they built, maybe we should pay attention. 1. The buyout is a signal, not a strategy. Banks aren't buying homes and farms because it's trendy. They're doing it because the future of money looks unstable. 2. Real assets become the new safe haven. In every historical reset, the winner is held. Land, energy, commodities, infrastructure, not paper promises. 3. The window is closing once institutions dominate ownership. The average person is locked out. Rent rises, food prices increase. Access to resources becomes restricted. The buyout isn't just a financial story. It's a societal transformation. We are living in a transition period, a moment where the old monetary system strains under its own weight, and the powerful quietly shift into assets that cannot be inflated, erased, or replaced. You don't have to be a billionaire or a bank to understand what's coming. You just have to watch what they're doing, not what they're saying. Because when the biggest players stop trusting the system, that's when you should question it too. If you found this breakdown valuable, hit like. Drop your thoughts in the comments, and subscribe for more deep dive financial storytelling. This is and this was the Quiet Buyout.